What if I told you the greatest danger to your portfolio isn't a recession, but the fact that we've been winning too perfectly? Since 2023, the S&P 500 is up nearly 80%. While Wall Street is celebrating a clear path to 8,100, history has a cold, mathematical truth. When miracles become expectations, gravity hits twice as hard. Today, we're exposing the 3 physical limits that could crush your gains. Stick around for reason number 3. It's a structural wall that most investors are completely ignoring, and it's the one that will likely trigger a significant market drop. The recap: what fueled the fire? Every stock price has 2 engines: multiple, which is sentiment, and earnings, which is reality. Let's look at the total return attribution chart. In 2023 and 2024, we bought the AI dream. In 2025, the baton passed to earnings, but for 2026 to hit those 8,100 targets, we need earnings to grow another 15 to 20% while valuations stay at record highs. It's like asking a world record sprinter to run faster while carrying a 50-pound backpack. It's not about effort anymore, it's about physical limits. Risk number 1, the gravity of valuation. Prices are the shadow of value. Right now, the shadow is running too far ahead. We are sitting at 22 times forward earnings, way above the 10-year average of 18.7 times. High valuation doesn't need a black swan to crash. It just needs good news to be not good enough. Think of a rubber band stretched to its limit. Even if no one cuts it, the internal tension will eventually snap it back to the center. At the start of 2026, ask yourself, is there more room for the rubber band to stretch, or is it time for the snapback? But valuation is just the surface. Let's talk about the most crowded trade in human history. Risk number 2, the end of the AI hall pass. For 3 years, Silicon Valley had a hall pass. If you mentioned AI, the market gave you a blank check. But 2026 is the year of the audit. Investors are moving from the dream to the receipt. With AI capital expenditure expected to top $520 billion, the market is no longer satisfied with cool demos. It wants ROI. Look at the risk this way. It's not about an AI bubble popping. It's about a correction of patience. If the monetization of these massive investments is delayed by even 1 quarter, the market will punish these stocks with zero mercy. The honeymoon is over and the bill has arrived. Now, the next risk is one most investors are ignoring. Risk number 3, the squeezed lemon. This is the wall I mentioned right at the start. Look at this 20-year chart. Net margins are hitting a historical high peak area. Companies grew profits by squeezing the lemon, mass layoffs, optimizing supply chains, and using cheap debt. But the lemon is dry. Wages are rigid, and the era of zero interest rates is dead. If companies can't cut costs anymore, they have to sell more to grow. In a low-gradient global economy, that is a brutal hill to climb. When this margin curve bends down, the EPS engine stalls. The flip side, the productivity miracle. Is there a way out? Yes, a productivity miracle. If a killer AI app emerges that fundamentally transforms legacy industries, law, manufacturing, energy, then these ceilings could be shattered. 2026 could be a launch pad rather than a cliff. But as a rational analyst, I don't bet on miracles. I prepare for the most likely probability, mean reversion. Investing isn't about being a psychic, it's about having an umbrella when the clouds look heavy. JP Morgan predicts a 35% recession probability for 2026. We are in a zero margin for error zone. So, if the crash comes, where do you hide? Consumer staples, bonds? I have a specific 2026 safe haven list, and I'll share it in my next video if we hit 100 likes on this one. So what are you waiting for? Hit that like button right now. For the full analysis report used in this video, check out the link in the description. Stay cautious, stay informed. I'll see you in the next one.